Well, it is my pleasure to introduce today's guest speaker and our last guest speaker of the semester, Mr. Jeff Knowlton. Jeff serves as the Chief Financial Officer for Heyman Capital Management, a hedge fund advisor in Dallas, Texas, which at its peak had over $2 billion of assets under management. He is also the Chief Financial Officer and Managing Director of Camino Verde Group, which you may remember Mike Ballard, who spoke earlier in the semester, was the CEO of. They're doing the Ephraim Crossing development here in Ephraim. Mr. Knowlton was also appointed as the CFO for Conservation Equity Management in February 2021, a private equity real estate advisor that has more than $100 million in commitments. As the CFO for CEM, Jeff is involved in various aspects of real estate diligence, including assisting with project modeling, obtaining financing from banks, structuring investment deals, overseeing legal relationships, creation of new entities, and management of bank relationships. Previously, Jeff worked for PricewaterhouseCoopers as an auditor. He studied accounting at BYU, where he obtained bachelor's and master's degrees in 2002. So please welcome Jeff Knowlton. Thanks so much.
Well, thanks everybody for being here. First of all, apologies in advance. You probably are wondering, why did I come to listen to an accountant, right? I get it, I understand. So hopefully expectations are low, because it's good to have low expectations because you can always exceed those expectations. So the first thing I want to show is, this is my family. The picture's a couple years old, but I have 3 daughters and a son. So my 2 oldest daughters are currently in college. And so I don't know if I'm comforted or nervous knowing that I'm speaking to basically a group of people like my kids. They give me a pretty hard time, so I would expect nothing less from you guys. So it's okay, I have tough skin after being with them. Your professor, Professor Tanner, Mr. Tanner, Russ, is what I was going to say. He mentioned a couple things. So I guess the first question is, when he reached out to me, he said, we have an entrepreneurship class. And my first question is, am I an entrepreneur, right? And so I don't necessarily think that that's a black or white question. You either are or you aren't. I think there's a whole spectrum. I think there's a lot of entrepreneurial activities you can be involved in. I did take a class in college. I remember sitting there and listening to Larry Miller, who is the owner of the Utah Jazz. He bought the Jazz and had a bunch of car dealerships. And so he came and spoke every week, and it was interesting to just hear some of his stories about business and learn from him. And I have an uncle that was an entrepreneur, so I was always interested in some of his experiences. So I feel like I've had an entrepreneurial bent to me, but I've also had some kind of maybe I'm not the traditional entrepreneur where I lead out and I'm the CEO and I am kind of the big idea person, right? So I've been involved in a lot of startups where maybe there's somebody that's the face of the organization. And as one of my coworkers said, you have the guy leading the parade and then you have people following behind with the buckets to clean up the mess. And so, some of what I've done throughout my career is kind of clean up the mess behind the parade. So I wanted to just kind of talk through some of the experiences that I've had throughout my career. Like, what are some of the lessons that I learned that if I was in your guys' seat, what would be kind of impactful or what would I think about? When I was going to college initially, I wanted to be a dentist. And I took a class, like a pre-dental class. And one of the stats was that dentists have the highest rate of divorce and highest rate of suicide of almost all professions. And then I went and met with the dentist who was in my neighborhood, and I shadowed him for an afternoon, and he pulled me aside and he said, hey, if you really want to work in people's mouths, go for it. But if it's all about the money, find something else, because there's a lot of ways to make money. So the next day I changed my major and I went into business. So then I got into business and I wasn't sure what I wanted to do. And I took an accounting class and they said, look, accounting's the language of business. Anything you do in business, you need to know the numbers. If you start a business, you need to know if you're profitable. If you need, you need to be able to identify strategic decisions. And so I studied accounting. I wasn't sure what I wanted to do with that, and Everybody else was going to work with the big four accounting firms. And I figured, I'll go do that for a few years. I quickly knew I didn't want to be a lifetime accountant. But I was grateful for the time because the experience, it taught me work ethic, it taught me good skills, it opened up doors, right? So like when I left public accounting, there were a lot of jobs that I interviewed for that if I hadn't worked in that, had that experience, I wouldn't have gotten an interview. And so that's a little bit kind of the framework of where I went. So shortly after public accounting, I left after 2.5 years. I went into private equity. So I went into the investment industry. Has anybody here heard about private equity funds or hedge funds? By the show of hands, if you've heard of a private equity fund, raise your hand. Hedge fund? All right, what about a family office? All right, so those are three things that I'll just give you a quick. So private equity, those are also known as PE funds, hedge fund, and family office. So just to give you a little bit of primer, because I think it's interesting to know, oh, thank you, to know how these things work. And I'll just take 2 minutes on this. So both of these are vehicles where you try and attract investors, and then you take the investor money and you invest it, and you try and generate attractive returns for them, and then you get a piece of the pie. And so with private equity, typically people commit to invest a certain amount over time. And then as you have deals, then you call that capital. So for example, if you're buying private companies or you're buying real estate or other kind of illiquid assets, like you might have a couple $100 million of commitments and you might do 10 deals during the life of the fund. And so then you buy those assets and then hopefully they increase in value. Then when you sell them, and the two ways that a private equity firm makes money is one, you charge a management fee that's usually 1.5% or 2% of assets. And so that kind of pays the rent and keeps the lights on and pays salary. But then on the back end, any profit that you have, you get 20% of that. So think about that. If you raise $100 million, and let's say you invest in a bunch of things and you double that, and you create $100 million of profit over 10 years. Right? So the economics of that would be you get 20% of $100 million, which would be $20 million. So all of a sudden, if you can scale that, the economics of a fund like that get pretty interesting. So a hedge fund is very similar to a private equity fund. The difference is when investors put their money in, they put all of their money in up front, and they have the chance to pull money out when they want to. So it's kind of like a mutual fund if you've heard of a mutual fund. So hedge funds invest in public equities like stocks, bonds, derivatives, commodities, pretty much anything that trades on an exchange, hedge funds can buy. It depends on the mandate, right? So each fund will have kind of an umbrella that their investments fall under. So when I left PwC, I went to work for a private equity firm in Dallas since I was an accounting manager. So that's kind of how I cut my teeth in the investment world. And I had been there for about a year, and the CFO called me in for my annual review, and I'll never forget the language he used. He was an evangelical. I was in the Bible Belt, so I spent 18 years in Dallas. So I went to BYU but moved to Dallas after graduation. And he sat me down and he said, "Hey, Jeff, you've done an awesome job. We're blessed to have you here in the firm." And then he went on to say, he said, "We believe that we pay you above market value, but if you believe that's not true, let me know and we can talk about it." That was kind of a weird thing to hear. So I left, and if that was you, what would you do? It's like, oh, I better figure out what my market value is, right? So I called a headhunter. Headhunters are people that help people, change jobs and they get paid for it. And I told him, hey, I'm open to kind of seeing what's out there. And so she lined up a bunch of different things, and I wasn't really interested in anything. And then she put me in contact with a guy named Kyle Bass, who was starting a hedge fund. And he had launched his hedge fund. He had $35 million of assets that he had raised already. So kind of in the grand scheme of things, it's a small fund. And I met him, and they had a handful of employees. So I showed up to interview, and nobody was there. They were out at lunch. And then when they showed up, the guy that I was interviewing with was wearing flip-flops, cargo shorts, and a t-shirt. And the office they were in was a mess. There were files everywhere. It was kind of a disaster. So my first thought was, there is no way that I'm going to work here. So during the interview, I didn't care. I didn't think much of it. But a couple weeks later, he called me back and he was like, hey, I really want you to work for me. Come, let me, tell you about the vision we have. So I reluctantly went back, and the more I talked to him, the more convincing he was, and the more interesting it became. And the one key, and this is something I wanted to point out, is as I talked about compensation, I said, look, if I'm going to join a startup, the only reason I'm going to do this is if I can get a share of the equity, right? I need to have some upside. If things go big, I want to know that I'm going to share in benefit from the success. And so he offered me equity plus kind of a decent base. And then while I was debating whether to take it, the existing firm I was at, they were raising another fund, and they came to me and said, hey, we're willing to give you some equity to thank you for the job you've done in this next fund. And I had to laugh because I thought, if they would have just given me equity, during my review, if they would have said, hey, you're doing a great job, we're going to give you some equity, then I wouldn't have gone out and looked. But because they said, let us know if you think you're undercompensated, then I went out and looked. And by that time, I was pretty interested in what we could do with the new shop. And so I decided to take the leap. And so, life at Heyman Capital was really interesting. So kind of a brand new startup. And one of the things about Kyle is his ability to kind of identify risk reward is pretty interesting. And so every investment you look at, you think about risk reward. So that's one thing I wanted to talk about today. And in everything we talk about, I think risk reward is an important piece. So for example, how often do you guys calculate risk reward in your lives? I would say like all day, every day, everything is a constant analysis. Like you're laying in bed thinking, should I brush my teeth or just fall asleep? It's kind of a bet. Like, am I going to get a cavity? Am I going to have the suffering later? You get a text as you're driving. Is the reward of checking that message worth the risk of a potential accident? Like, you decide to go to college. Is the risk of taking time away from other work, is the potential benefit going to exceed the expense of going to school? As you consider a profession. So then the other thing is, how much risk are you comfortable taking? And I think everybody has a different answer to that. And, I don't think it's always the same. Like I've been skydiving and I've, done some other things. I didn't feel like they were excessively risky, but, a life insurance provider or other people might look at that and say, oh, that's a little bit, more of a risky lifestyle than people would want to cover. And then I guess the other question is, how does risk reward relate to entrepreneurship? So what are your guys' thoughts? As you think about risk rewards, how do we think about that in terms of being an entrepreneur? What do you think? There can definitely be financial risks. Like if you launch a new company, you have to be comfortable with the financial risks you're taking. What were you? I saw a hand back here. No? Right here? Frequently, the higher the risk, the higher reward. But that's where the assessment becomes so important, right? So the other key is, how many people, is anybody here married yet, or is everybody single? We got a couple people married? Okay. Do some people think they might get married at some point? Most people are probably shaking their head. The question isn't just how much risk you can tolerate, but how much can your spouse tolerate, right? So that's a lesson that I've learned, is it's not just me, but it's kind of a family dynamic. So you have financial risks. Has anybody heard about a personal guarantee? So a lot of times if you get a loan for a business, not only do you have to pay back the loan, but if things go south, they might require you to pay that back even if the business doesn't exist anymore, right? So I have an uncle that started a company and he had a house, and he had to pledge that house as collateral against the company. So I would say high risk, but then the company was successful. He ended up going public and made millions of dollars. So it ended up being super high reward. Um, like if you put money in your business, there's a risk that it could be lost. There's reputational risk, right? Like I was exploring joining Mike with Camino Verde Group. And I have to think, look, I've had a 20-year career. If I go in with this group and things don't go well, what does that do reputationally? Like how many bites of the apple do you get? You have professional risk, like the opportunity cost of could I have done something different or something alternatively? And then, food and shelter. If you lose your house and you have all these debts, what are you going to do to support your family? Now, there's different ways you can decrease the risk. You can, launch a business on the side. I currently have kind of my CFO job, but I'm also working with Mike in the real estate group, right? And so I've mitigated my risk because I still am getting a paycheck and insurance is covered, but I'm also kind of expanding and developing on the side. Now, there's drawbacks to that, right? I can't dedicate as much time and attention as I would, but the downside, right? So there's tension and balance between the two. Maybe bringing on a partner. That's one way to decrease the risk, but you're probably going to give up some of the upside. Doing proper due diligence is a way to decrease risk. Having a contingency plan. So, sometimes there's safety nets with family and church or government programs. But I think it's just, as you said, without risk, there's no reward. But taking unwise risks can cost you everything. So, risk in itself isn't bad, but it's all about choosing the right risks to take. So that, to me, is one of the big keys of what I want to talk about. So this is a little matrix I put together. It's really basic and really simple. But basically, you have risk on the x-axis and reward on the y-axis. And, where do you want to be on this, right? And I think that's what you have to determine. Where are you comfortable and where do you want to be? And I think where we all want to be is high reward, low risk. Isn't that like the perfect scenario? And probably the worst scenario is high risk, low reward. And so for every situation you're in, you can kind of think about, okay, how risky is this and how big is the reward, right? So like when I joined the hedge fund, I actually had a neighbor of mine, he was the CEO of a public company. He's like, ooh, you sure you want to do that? The PE firm is going really well. That seems like a pretty risky move. I'm like, well, look, we have a 2-year runway. I know that I'll be employed for 2 years, and I have equity. If it goes well, pretty big reward, and probably moderate on the risk, right? So if you look at it from this way, it's probably moderate risk, not high risk. Now let's kind of put this into practice a little bit. So here's 2 different scenarios that have come from my investment life, right? So this is a chance for you guys to look at them and look at what you would do. So investment 1. Here's a deal that has upside potential of 10x, right? So you invest $1, you potentially get 11 back. And downside risk of 33 to 40% over 3 years. How many people take this deal?
Well, what does downside risk of 33%?
So that means that if you invest $1, that over 3 years you lose 40% of it, so you get 60 cents back. So if things go poorly, you get 60 cents back, you lose 40 cents. If things go well, best case scenario is you get $11 back. And then in the middle is somewhere in between.
What is the likelihood that you would get the potential upside?
Call it a coin flip. Some people would say it's unlikely, but maybe you feel it's probably 60% that it'll be somewhat positive. So this was the first big decision I was faced with. Is anybody here familiar with the movie Big Short? So I think it's about 10 years old. So for me, it wasn't that long ago, but for you guys, it was half a lifetime ago. Essentially, when I started with the hedge fund, and I'll try and move this along, but it's kind of foundational for what happened. When I started with the hedge fund, my boss came in, Kyle, and he's like, how big is the US mortgage market? We're like, I don't know. So we started guessing, and then we would Google and see who was right. And then he said, there's a product out there where we can basically short the whole mortgage market. Shorting means, from investing terms, going long means you're betting that it's going to go up. Going short means you're betting that it's going to go down. And so he said, it's like you're buying a life insurance policy on a patient, and if they died, you get the money, right? And so at the time, the lending standards for homes had gotten very relaxed. There were all sorts of problems with what's called liar loans, and so people were able to get a loan without any income verification. So you could just sign a paper and say, I make X amount of dollars, and they would let you buy the house. And because property values were appreciating so much, nobody had any issues. But then the question is, what happens if property values stop appreciating, or what if they go down? And so that's where we came in. So we put together this investment. You know, we had this main fund that we had. We had like $50 million in the fund. We started putting these investments in. Then Kyle came in one day and said, hey, this is such a good idea. We need to create a separate fund just for this idea and invest it. And I sat through the investment pitch, and this was basically the economics. So I walked out, and what did I do? I went and borrowed money on a credit card to invest in the deal, my own personal money. Like I had upside if it happened, but I was like, this is so compelling economically, I want exposure to it. If the deal goes bad, I have a plan to pay it back, you know, but it's going to be painful. But if it goes well, this could be a real accelerant in our life. And so kind of 2007, 2008, what happened? Oh, so with that special fund, he actually went out and was tenacious and was able to raise $110 million just for that special fund. And so we put on these positions. We had $1.2 billion of notional exposure, and then the financial markets started to crack. So there was this big like housing bust in 2007, and all these mortgages started to go bad. And what they had done is they had pulled all these mortgages together in bonds and securitized them. And so the people that owned those bonds started to lose money, and we had insurance against default on those bonds. And so as the losses started to pile up, the value of our position started to skyrocket. And so we ended up in this special fund. We made 5.5 times our money. So we didn't hold out till the end because we wanted to lock in a successful outcome. But still 5.5 times is a pretty successful outcome. So somebody that put in $100,000, they would have made $550,000. And we had one guy, Kyle met with him, and after 1 hour meeting, he said, I'm willing to put in $20 million. And over the weekend, his accountant talked him down to $10 million. So we always laughed about how that $10 million difference made, that was a $55 million impact on the bottom line at the end of the day. The other thing that we talked about is how interesting it is that once the numbers get big, the process you go through is basically the same process. So whether you're doing it for kind of small numbers or big numbers, it's really not that different. But it's sure a whole lot more fun when the numbers get a little bit bigger. So because of that success, our fund grew. We started out at $50 million. We made 200% in our main fund in 2007. And so then that created a lot of notoriety. So this is Kyle right there. That's when he was being interviewed. So at the bottom, there were a bunch of write-ups in Bloomberg and Wall Street Journal and different things. And Kyle didn't mind the media, and so a lot of people would talk to him. And so at one point, we actually grew to $2 billion. And so as we went, we launched a handful of different funds. So a couple of funds we launched and they didn't go well. So in 2008, we had all this momentum, so we launched a real estate fund. We partnered with the group, and the thought was, hey, there's all this distressed real estate. Let's go buy it up. We're going to make great returns. Well, this group that we partnered with, they had trouble raising money, and so it launched, but it didn't go well, and it was a 15-year fund, and people got their money mostly back, but really very little return. So that was a very unsuccessful fund. And then we had a muni bond trade. We were going to do a levered trade, and so we were going to borrow money to buy muni bonds and kind of stack them. But then there was some volatility in the market, and a couple of funds that did that went out of business. And so we ended up saying, okay, we're not going to use leverage. So then it was kind of a boring trade. And so we did that for about a year, and then we closed it. So kind of a side note, do you guys think leverage is a good thing or a bad thing?
Depends on who's using it.
And how? I would say it's inherently neither good or bad, but what leverage does is it enhances the outcome, right? So if you use leverage and things go well, it'll enhance the good performance. If you use leverage and it goes poorly, it magnifies that and it can carry people out, right? So that's part of the risk reward analysis, as you're thinking of that spectrum. So kind of fast forward, we closed our main fund in 2021. So typical hedge funds have about a 4-year life cycle. I didn't know that when I first took the job, so I probably should have done a little bit better research. So we lasted 16 years, so we had a great run. And we currently have one fund left, and it's a bet on the Hong Kong dollar. And so the Hong Kong dollar has been pegged to the US dollar for about 35 years. And, so the marketplace provides a very low probability that that peg will break. And we believe that the odds of it breaking are higher than the marketplace gives. And so we've raised money. We have about $40 million of capital put to work at this. And so if the peg ever breaks, look up Heyman Capital, and there will be articles written because some of our investors have over 200 times leverage, right? But that's more of a all or nothing bet, where if the thesis doesn't happen, it goes to zero. But if it does happen, it could be 200 times your money, right? So that's kind of an extreme example of super high risk, super high reward. So then Kyle, in 2021, decided, well, one of the things that Kyle loves, he lives in Texas. People with money in Texas, what do? They buy ranches, right? So he owned a ranch with some buddies. The partnership allowed for it to be sold if one of the partners wanted to sell. So his buddies wanted to sell. And so he got some proceeds from the sale, so he put it back in another ranch. But it wasn't very well developed. And so everybody told him, hey, you need to meet Terry Anderson. He's the best ranch manager out there. So he started working with Terry. Terry helped him with a few things. Oh, and when I say ranch, it's like a 4,000-acre ranch, right? So it's not like a small 50-acre ranch. And so he worked with Terry, and Terry had a couple ways to kind of monetize ranches that were pretty attractive. And Kyle recognized that, so they did a deal together in Fort Worth. And Kyle went to him and he said, hey, you're really good at what you do. I'm good at raising money, and I really like ranches, and I'm good with kind of macroeconomics, and given where we're at with Fed interest rate policy, why don't we raise a fund for this strategy and we'll partner together? So that's kind of how we pivoted from kind of a hedge fund to being a private equity fund. So we went out and we raised $130 million for this new venture, and we've bought 40,000 acres. We have about 7 different projects that we've done. So we're about 2 years into it, and we're super excited about what we're doing. And so the idea is, demonstrate some really good returns in Fund 1, and then maybe roll out Fund 2, right? A lot of investors that we talked to said, hey, this is really interesting, but let me see you do it first, and then once you've done it once, maybe we'll invest a second time. So that's kind of how that venture came up. Yep. So then, this was kind of during COVID as well, so I decided to move back to Utah. I went to Kyle, and he was amenable to me working remotely because a lot of remote options existed. I have family near Salt Lake. My wife is from Ogden, so we thought we might get back one day. And so I travel back and forth occasionally. And one time, as I was flying back and forth, I sat next to Mike Ballard, who presented to you guys a couple months ago. And we sat next to each other on a plane, so we just started chatting. And so he started telling me about some of the real estate deals he was in. And I had just sold my house in Dallas, and I had some money I wanted to put into hard assets. So I was interested in investing, and then I started asking him all these questions about like business operations. How do you do this? How do you do that? And it became evident that some of the skills that I had could be useful to what they were doing. And so kind of one thing led to another, and they let me join in some of their real estate deals, kind of on the investment side, but also kind of on the ownership side. So that's kind of how CVG came into place. So Mike and Kevin started that about 4 years ago, and they've bought 13 different apartment complexes, and they have about 10 different developments that they're working on. And so they've been pretty active in doing that. And so those are kind of a lot of different kind of tentacles. The other thing I was going to mention is Kyle, when he, we had really good success as a firm in '07 and '08. And so in about 2010, 2011, he created what's called a family office. Does anybody know what a family office is? Typically a family office, and there's a lot of different ways it can be structured, but basically when you have families that sell a business and come into a lot of money, they need to manage that. So rather than just pay people on an ad hoc basis, they create their own business that basically manages their wealth for them and their posterity. And so because we already had the hedge fund, Kyle kind of set up a family office underneath the umbrella of his hedge fund. So he, is in charge of making all his investment decisions for himself, but then we have accountants and lawyers and different people that help him with all kind of the other things to deal with that. So it's a pretty good deal for him. Now, one of the benefits for me is a lot of people approach him to invest in private deals. And so it's been really interesting to see the deals that cross his plate. All things from real estate to oil and gas. One of the deals that we participated in was a security deal. Has anybody here heard of Chris Kyle? He was a Navy SEAL. There was a movie made about him called, I think, American Sniper. And so when Chris Kyle left the Navy, Kyle Bass actually got together a bunch of his friends and they raised the equity for the original business that Chris started when he came out of the military. And so he actually shared our office for a while in Dallas, right? So I'd walk in and see like Chris Kyle and some other Navy SEALs as we walked around. So it's kind of interesting environment. Another deal, I'll just share with you a couple of kind of interesting deals that we've done as we finish it up, and then I'll have some lessons. Another interesting deal we did was Kyle met a guy that started a hot sauce company, right? So being involved at the family office, one of the cool things also is sometimes Kyle would let me invest alongside, right? So there's this hot sauce company called Melinda's. If you haven't heard about it, hopefully one day you do. And they're based in Dallas, and they just were kind of ground up, and they were getting some traction, and they needed some capital to expand. Because if you're in the retail business, you need to kind of pay shelving fees, stocking fees, and other fees. Well, we've been invested for about 4 years, and they just signed a couple of big contracts with Walmart and some other people that have dramatically increased their sales. So that's one. So it's almost like angel investing, right? Where you see these opportunities, maybe have people that are running the business, you provide some capital, and on the back end, when it sells, hopefully there's kind of an interesting payoff at the end. This is one that I did. On the side, I started doing some alternative investing myself. So there was a group that wanted to buy a limestone mine in Florida. And so I ended up getting involved in this limestone mine. And when you think about risk reward, I would say super high risk, but potentially super high reward. And limestone was really interesting because it could be used for all different types of things. And the whole thing has kind of a really interesting story. But basically, when I set it up, I said, look, they were using my money to buy a piece of land that was right in the middle of the mine. The mine's 1,200 acres, and they bought 40 acres right in the middle of the mine. So right in the middle is this 40 acres. And I set it up, I said, look, I'll give you guys the money, but if you guys don't perform, then basically I own the company, and I own the real estate, right? And so they did that. So then a couple of years later, they didn't perform. I own the real estate. They wanted, or I was looking to maybe pivot and sell it to somebody else. And when they did a title check, they found out that the initial company had transferred title to the 40 acres to a different name. So they basically stole my land from me. So what did I do? I went and got a lawyer, and I filed a lawsuit the next day. So first lawsuit that I had ever filed, I was livid. So I confronted him, and I was livid. So that night we dropped the lawsuit, and within 3 days they transferred the title back, and we settled the lawsuit. So that's an interesting one. It's still not resolved, and so there's still a chance that there's a successful outcome. In hindsight, it's one that I wouldn't do. It's probably too far out of my realm of expertise, and there were too many kind of hairy pieces with it. But that's part of life, is a learning experience, and every deal that you do, you kind of gain wisdom and understanding. So I'm just going to roll through maybe a couple of lessons that maybe I learned and we kind of discussed as we were going. So look, there's a lot of different ways to be an entrepreneur. Figure out what's the best fit for your skills and your aptitude. So for me, I don't feel like being the CEO and kind of the trailblazer is my spot. I'm kind of more of like the second guy, right? Maybe some guys are the gas and some guys are the brakes. Maybe I'm a little bit more the brakes. Maybe, I help with compliance and I help, keep everything in line. But I'm not risk averse. I mean, you've seen I bought a 40-acre limestone mine. I borrowed money to invest, in some of the deals. So it's trying to figure out when to take your risks. Continue developing your skill set. Like, lifelong learning is what it's all about. And so no matter what you do, like, you want to figure out how you can add value to whatever organization you're in. If you don't add value, they're going to remove you. If you add value, you'll stick around. There's great security in being undercompensated for what you do. Early career experiences can open doors later in life. And so I didn't enjoy PwC, but I was glad I did it because it got me interviews that I probably wouldn't have gotten. When I was in college, one of the professors said, look, as you think about decisions, ask yourself, will it give you more options or fewer options? And it's always good to have options. And so that was one thing I've looked at is, do I want to specialize or be more general, and am I going to have options? And so that's one thing I've tried to do, is to have options. Also, opportunities exist at the intersection of competence, right? So I've worked at this investment company, and so I've learned about legal documents, I've learned accounting, I've learned investment management. And so, you develop kind of this Venn diagram of expertise, and so then opportunities come along. Like, Kyle, it's kind of interesting, he has this real interesting skill set, and now he's buying ranch land. Like, I doubt at the beginning of his career, he thought, I'm going to be this big owner of ranch land. And so, you just kind of have to learn as you go and then identify opportunities and be willing to act. Another big one is, especially if you're working for a startup, always ask for equity, right? That was what I did when I joined Kyle, and I'm so glad I did, right? When things went well, we knew what the percentage was, and he was always good for it. Other interesting fact is, I've never had an employment agreement with him, right? It was a handshake deal, and I trusted him, and he trusted me, and he's always delivered. And so, I almost felt like if I put the paper in front of him to make him, and I'm not saying that's the right way every time, but he had a lady that had worked for him for 15 years, and she had a handshake deal, and he had always honored it. So I was like, you know what? I'm going to follow the same path and do the same thing. I would also say that each person's risk tolerance is different, right? And that's okay. So part of it is figuring out where yours is and act accordingly. Think about the risk matrix. I don't know that I want to start a business and, pledge my house as collateral against the business. Like, to me, that's a little bit more risk than I want to take on. But for my uncle, that was the right thing for him to do. For me, the right level of risk was maybe stepping out of the professional track I was on and joining a startup and, doing something like that. And then also be thoughtful how you capitalize your business. If you start a business, what do you do with the equity? What do you do with the debt? Those are extremely important things, and you can have pretty extensive discussions about that. But that's when it's fun. What's that? Yep. So that's the end of the presentation. If there's any questions, happy to answer them, but I'll be at lunch, and it looks like there's incentive to be there, so it's always good when incentives are aligned.
Thank you, Jeff. Thank you so much.